What are the qualities of successful investing? What are so many question paper? As an investor, what he will do, he will analyze, avoid the risk, he will put the portfolio into spread the risk in across the different assets. Hello, my dear students. I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. In this session, I am going to hand Security Analysis and Portfolio Management 6th semester session 4 in favor of Model Question Paper 25-26. In the last session, I solved the problems about 10 marks. Previously, we already solved 2 marks, 10 marks. Today, in 15 marks, we already solved 2 questions. Another 2 questions I'm going to solve today. So we'll move on to problem now. Calculate the portfolio risk, nothing but start with 3 security. So far, we did only 2 security. Now we go with the 3 securities. We'll move on. I will write the formula. Risk or standard deviation is equal to root of W1 square. See that? Standard deviation 1 square plus W2 square, standard deviation 2 square plus W3 square, standard deviation 3 square. Now 1 and 2. See that? This is 1 and 2 plus 2 into W1, W2, standard deviation 1, standard deviation 2, standard deviation 1, standard deviation 2, R of 1, 2 plus second one 1 and 3, 2 into W1, W3, standard deviation 1, standard deviation 3, R of 1, 3 plus 2, 3, 2 into W2, W3, standard deviation 2, standard deviation 3, R of 2, 3. So, it's a rotation system. One, if you have got like this, 1, 2, 3. If you have got 1, 2, 3, first 1 and 2, 2 and 3, 3 and 1. How it will be? 1 and 2, 2 and 3, 3 and 1. So this is 2 into W1, W2, standard deviation 1, standard deviation R of 1, 2. Here 2 into W1, W3, R1, R3, R1, 3. 2 into W2, W3, standard deviation 2, standard deviation R of 2, 3 is equal to root of, apply. What is W1 square? W1 is 0.3 into standard deviation 1, 6. This is one group plus W2, 0.5 whole square into standard deviation 2, 9 plus W3, 0.2 square into standard deviation 3, 10 square. This is another group plus 2 into W1 into W2 into standard deviation 1 into standard deviation 2 into 1, 2 is R is 0.4. 0.4. Then plus 2 into this over 2 and 3. 2 into W1 0.3 into W3 0.2 into R standard deviation 1 6 into standard deviation 3 10. This is 2 into 1 3 1 3 into what is 1 3 0.6 plus 2 into last one W2 0.5 into W3 0.2 into standard deviation 2 9 into standard deviation 3 10 into R of 2 3 R of 2 3 0.7 0.3 0.5 6 9 4 2 into 0.3 0.26 into 10 into 0.6 then 2 into 0.5 into 0.2 into 9 10 0.7. Simplify this. Next, root of 0.3 square (0.09) into 6 square is 36 plus 0.5 square (0.25) into 9 square 81 plus 0.2 square 0.04 into 10 square 100 plus 2 into W1 0.3 into W2 0.5 into standard deviation 1 6 standard deviation 2 9 6 into 9 into correlation. This is 1 to 0.4 plus 2 into next this over this one W1 0.3 0.2 into standard deviation 1 6 into standard deviation 3 10 into correlation 1 and 3 0.6 plus 2 into W2 0.5, then W3 0.2 into standard deviation 2, standard deviation 3, 9, 10 into correlation 2, 3, 0.7. Simplify. Root of 0.09 into 36, 3.24 plus 0.25 into 81, 20.25. I'll repeat this one. 0.09 into 36, 3.24 plus 0.25 into 81, 20.25. So 0.09 into 36, 0.25 into 81 plus 0.04 into 100 I'll repeat. 0.04 into 100 is equal to 4 plus 2 into 0.3 into 0.5 into 6 into 9 into 0.4, 6.48 plus this over this one. 2 into 0.3 into 0.2 into 6 into 2 into 0.3 into 0.2 into 6 into 10 into 0.6, 4.32. Last one. This over this one. 2 into 0.5 into 0.2 into 9 into 10 into 0.7, 12.6. So add the figure. 3.24 plus 20.25 plus 4 plus 6.48 plus 4.32 plus 12.6, 50.89. Repeat. 3.24 plus 20.25 plus 4 plus 6.48 plus 4.32 plus 12.6, 50.89. Root of this 7 point standard deviation is equal to 7.13% risk. So this you must be very careful in rotation. W1 square standard deviation 1 square, W2 square standard deviation 2 square, W3 square standard deviation 2 into W1, W2 standard deviation 1 standard deviation R of 1, 2, 1 and 3, 2 into W1, W3 standard deviation 1 standard deviation R of 1, 3, 2, 3, 2 into W2, W3 standard deviation 2 standard deviation 3 R of 2 application. The final answer is 7.13. Hope you understand. This goes in favor of 3 securities. This is the very common question that is going to be asked in the examination point of view. What are the qualities of successful investing? What are so many question paper? Always this question is asked. That's why I'm going to answer this question. We'll want to answer 15 marks question. What are the qualities of successful investing? The answer is number 1, research. Successful investor thoroughly research potential investment, including analyzing financial statement, market trend, and industry dynamic. As an investor, what he will do, he will analyze the financial statement, means statement of profit and loss account and a balance sheet. Profit and loss account shows the profit, whereas the balance sheet shows the financial position. He will analyze and also market trend and industry's dynamics. So second one, risk management. They understand and manage risk effectively, diversify their portfolio to spread risk across different assets and sector. Every investor knows that when you invest the money, there will be risk. So in order to, avoid the risk, he will put the portfolio into spread the risk in across a different asset. Patience. Successful investors have a long-term perspective, understanding that investment is a marathon, not a sprint. It's a long process. Investment is not a problem. If they put the money, we'll get back the profit in next day. It is not possible. It's a long-term process. They do not panic during the short-term market fluctuation. They are not at all interested. They may not be panic for a short term because they are waiting for the long-term process. Discipline. They stick to their investment strategy even when emotions are running high, avoiding impulsive decision based on fear or greed. So this discipline is most important. They stick to their investment strategy. They have got their own strategy. Even when emotions are running high, avoiding impulsive decision based on fear or greed. All important points to bear in mind. Number 5, knowledge. Successful investor continuously educate themselves about the financial market. Whatever the financial markets are available, he has to educate. Every day he has to read and find out what's the position of the market. Then only he will be considered as a financial manager. He must understand what is going on in the market, why our product is not properly selling. All this he has to study. Investment strategies and economic trend. Then adaptability. They are flexible and willing to adjust their investment approach based on changing market condition and new information. So once you invest, you should not be stick on to that particular. According to market, he has to change the investment in India. Willing to adjust their investment approach based on changing market condition and new information. Emotional control. They keep their emotions in check, avoiding irrational decisions driven by fear or overconfidence. So emotional confidence is such a way that they keep their emotion in check, avoiding irrational decisions driven by fear or overconfidence. Goal setting. Successful investors have clear investment goals and a plan. They will have a certain particular clear. Successful investor have clear investment goals. We have got our own goals and a plan to achieve them. They regularly review their progress and make adjustment as needed. Consistency. They consistently contribute to their investment accounts over time, taking advantage of the power of the corresponding return. Whatever the return we have got, according to return, he will consistently contribute. Then focus on fundamental. They focus on the fundamental value of investment rather than short-term price movement or market speculation. So they have got an idea only long-term planning. They don't bother about the short-term. So they are not at all planning for short-term. They are always thinking on the long-term plan. They have got their own views. They have got their own idea. They have got their own plans. Long-term perspective. They prioritize long-term wealth accumulation over short-term gain, understanding that compound growth takes time to realize its full potential. In order to have a growth, you must have compound growth. So accumulated growth, time to realize its full potential. Portfolio diversification. Successful investor spread their investment across different asset classes, industries, and geographic regions to reduce risk and increase potential term. Here, he wants to get back the potential returns he wants. So he has to wait for a long term. He has got a plan. He has got an idea. He has got a goal. Investor has a goal. But he must have a patience to wait, because short-term answer is not at all possible. You have to wait for a long-term planning. Monitoring and review. They regularly monitor their investment. They have to look after every day. They have to look after, monitor their investment and review their portfolio. What are the performance that is going on for our portfolio, making adjustment as necessary to stay aligned with their goals. Whatever the goals is, according to that only portfolio should be adjusted. Cost consciousness. They minimize investment cost, including fees and taxing, to maximize return over the long term. So the cost should be cut off. More cost could be cut off. We have got a more gain. Cost and taxes should be cut off so that we can realize more profit. Then 15, continuous improvement. Successful investors are always looking for ways to improve their investment skills and strategies, whether through self-study, mentorship, or professional advice. So if you want an improvement in investment, he must take the advice of the mentorship or professional advice in the financial management and investment skill and strategies they have to understand, because we have to wait for a long term to get back more profit just to investment and not keep it. So you must have a market idea. You have to approach all these persons so that they can give their idea. You already invested and which portfolio you have to invest. If the money is not coming properly, what to do? All these ideas will be given by professional advice. So all the 15 points to be there in mind. You have in examination, first write down the points, 15 points you write down. For each point, you have to explain slightly so that it will reach the particular goal of the answer. So whatever the answer, successful question, that answer will come. Hope you understand. So we solved about 3 problems and 1 theory. And in the second also, the 10 marks question also solved. So generally, whatever the question they ask, and also regarding this trainers index, sharp index, Jensen index. There is a common question they are asking from the since 2 years, 24-25 exam. Same type of question. Give more weightage to that. 15 marks. 10 marks now they ask for risk and return so far. Others are theory. So hope you understand. Please go through the theory. Whatever the theory which I have given to you in the PDF, please go through it and you understand. I solve the model question paper. Definitely it will help you from the examination point of view. I wish you best of luck in the coming examination. Thank you. Thank you very much. We'll have a hope you will go through that and study well. Bring the good name to the institution, to your parents, if possible, for your teachers. Okay, goodbye. Thank you.